Hello friends, welcome back to my class. In the last class, we have studied about what debit is, what credit is, how do we pass a journal entry using a very simple method. Or I can say method if someone is from a non-accounting background, they can also clearly get it by understanding whatever was explained in the last class. Today I'll take you through the methods which are designed in the accounting background for passing the journal entries. The two methods which are generally used are the accounting equation method or the modern approach method, and the second one is the golden rule or the traditional approach. Any of the method being followed will give you the same result, like the same account will be debited, the same account will be credited. Even if you follow the method which I have told you in the last class, even that will give you the same result. So based on your convenience and ease, you can use any of the method and chalk out journal entries. So we'll go with the first one, which is accounting equation method or the modern approach method. What is accounting equation method or balance sheet equation method or modern approach? This method states that at any given point of time, the total assets of the business should be equal to the total liability of the business. When I say total asset, it means the total resources which the company owns, which the company or the business has. It should be equal to the total claim in the business. Claim, I mean whatever is the liability of the business. If someone is claiming the amount, that amount should be equal to the amount which the company is owning. I'll apprehend that with an example. If you see the asset of the business on 31st January 2024 is 10,000. So we will find out that and we'll see that the capital and liability will equal to 10,000 on the same day. So that is what is the claim in the business should be equal to the resources of the business. All the asset balances are debit balance. So whenever there is an asset, it will be a debit balance, and whenever there will be liability, it will be credit balance. You'll get more clarity as and when we proceed through various slides. Now, using this modern approach or the balance sheet approach, we will see that what are the accounts which are debited or the scenarios where the accounts are debited. If there is an increase in asset, if there is a decrease in liability or capital, if there is an increase in expenses or losses, or if there is a decrease in revenue or gain. So these are the scenarios in which the respective accounts, I mean the asset account, if there is an increase in the asset account will be debited. If there is a decrease in the liability or capital, the liability or capital account will be debited. If there is an increase in expenses or losses, that respective expense or loss account will be debited. And if there is a decrease in revenue or gain, that respective revenue or gain account will be debited. So these are the scenarios when we will see that these accounts are getting debited. So we'll proceed with the first one, which is increase in asset. Increase in asset is always debited. We will see that with the help of an example. So Mehta Bookstore will continue with the Mehta Bookstore as we have been using it since our previous classes. So Mehta Bookstore purchased fan for his shop by paying 5,000 cash. So we are well versed that Mehta Bookstore is dealing with books. Fan is an asset for Mehta Bookstore. Since a fan is purchased for the purpose of the shop and not for the purpose of selling, that seems to be an asset. And if there is an increase in asset, what will be debited? That respective asset will be debited. Here, what is the asset? Fan is the asset. So fan will be debited. And since we are paying cash, cash is credited. So the entry will be fan debited to cash credit. Now moving on to the next one, which is decrease in liability is always debited. If we see payment made by Mehta Bookstore to a dealer Hari on 12th January for books purchased by Mehta Bookstore on bulk in 10th January. So here there are two cases. Firstly, on 10th January, Mehta Bookstore purchased books from Hari. Since they have purchased books, which is a good for Mehta Bookstore, they have what needs to be debited then? Purchases account. So on 10th, when the goods were purchased, what will be the entry? Purchases account debit to Hari account. Had the case been paid, then on 10th January the entry would have been purchases account debit to cash account. But here, since we have not made the payment to Hari, who is our creditor, Hari will be credited. Now on 12th, what happened on 12th? So firstly we'll see on 10th. On 10th, when they purchase the books, they have created a liability for themselves, which means that the liability is increased on 10th. But on 12th, what happened? They made the payment and their liability decreased. Since the liability is decreased on 12th because of the payment being made, that respective liability account will be debited. So the entry on 12th will be Hari account debit to cash, because here what is happening is Hari, the liability is getting reduced by payment of cash. Since cash is going out, it will be credited, and Hari, being the decrease in the liability, will be debited. Now moving on to the next one, which is decrease in capital, will be debited. Capital is the amount which is invested by the owner in the business. Now, Mr. Mehta, being the owner, invested 50,000 on 10th January and he withdrew 15,000 back on 15th February. So, what is happening is on 10th January, there is an increase in the capital. But what is happening on 15th February? There is a decrease in the capital because Mr. Mehta is withdrawing that money back. So on 10th, when Mr. Mehta is bringing in the money, what is happening? Cash is coming in. He is bringing the money in the form of cash. So the entry on 10th January will be cash account debit to capital account. Then on 15th February, what is happening is Mr. Mehta is taking back the money. Since the money is taken back on 15th February, there is a decrease in capital. And since there is a decrease in the capital, that decrease in the capital account or that respective account will be debited. So the entry will be capital account debit to cash account, because cash, Mr. Mehta is taking the money back in the form of cash and capital is being debited because the capital is reducing. So the entry will be capital debit to cash. Now increase in expenses. We will see that Mehta Bookstore paid shop rent of 20,000. Any expenses which is being made will be debited. So here the shop rent being paid is an expense and thus that shop rent account will be debited. And since it is paid in cash and cash is going out, so the entry will be rent account debit to cash account. Now increase in loss is debited. So loss, Ram lost mobile while walking in the street. Since there is a loss account will be debited. What is Ram losing here? Ram is losing mobile. So the mobile is going out from his hand. What will be debited? Loss account will be debited. And what is going? Mobile. So loss account debit to mobile. Okay. Now next is decrease in revenue is debited. Decrease in revenue. So till now we have covered what? Increase in asset, decrease in liability, decrease in capital, increase in expenses, increase in losses. So all these are the scenarios when the respective account will be debited. Now we will see two more scenarios, which is decrease in revenue and decrease in gain, wherein the respective account will be debited. Decrease in revenue will always be debited. So what happens is that Mr. Mehta sold goods of 10,000 to Priya on 10th January. She returned few books of 1500 back to Mehta Bookstore on 15th February. So first Mehta Bookstore sold the books to Priya. It means there was an increase in revenue or increase in sales. What is happening then on 15th February? Priya is giving back some books. So there is now a decrease in revenue because she is returning the goods which she has purchased. So on 10th January, when the books were actually sold to Priya, what will be the entry? Because cash is being received and sale happened, so the entry will be cash account debit to sales. Then on 15th, what is happening? There is a decrease in revenue because Priya is returning back the book. So the entry will be sale return account debit to cash, because now Mehta Bookstore has to give back 1500 worth of cash which Priya has gave on 10th January. So this entry of 15th February, this shows the decrease in revenue, which is always debited. Now the next one is decrease in gain. When we say decrease in gain, it basically means loss. Decrease in gain is equal to loss. So Mehta Bookstore sold fen at 4,000, which was purchased for 5,000. The fen was purchased for 5,000, but now it is sold at 4,000. So what will be the entry? The entry will be cash debited. How much cash are we receiving? We are receiving a cash of 4,000. And how much loss we are bearing? We are bearing a loss of 1,000. So the cash account will be debited with 4,000. Loss account will be debited with 1,000. And we have, what was the value of the fan? The value of the fan was 5,000. So credit will be fan 5,000. So these are the scenarios we have discussed wherein the account will always be debited. Increase in asset, decrease in liability, decrease in capital, increase in expenses, increase in losses, decrease in revenue, decrease in gain. Now you may feel that this needs to be by hearted, but as in when you start doing journal entries and like after some time you'll feel that it's coming automatically. You don't need to by heart this, that if there is an increase in asset then it will be debited. So it all comes from practice. Increase in asset, decrease in liability, decrease in capital, increase in expenses, increase in losses, decrease in revenue, decrease in gain. Now we'll cover the next one, which is the scenarios when the respective accounts will be credited. So credited will be just opposite of debited. So decrease in asset, if there is a decrease in asset, the asset account will be credited. If there is an increase in liability or capital, that respective account will be credited. If there is a decrease in expense or losses, that account will be credited. And if there is an increase in revenue or gain, that account will be credited. Again, we'll see that with the help of an example for each of these cases. Like decrease in asset is credited. Mehta Bookstore sold fan which was purchased for 4,000. Now they have sold the fan for 4,000. What is happening? What is going from their hand from Mehta Bookstore? If I follow the old approach, fan is going. What is coming in? Cash. Cash is coming in. Since the fan is sold, which is an asset, there is a decrease in asset. So that decrease will be credited. And at the same time, cash, which is an asset, cash is increasing. Increase in asset is debited. So here you will see that cash account is debited, fan account is credited. Now you see increase in capital is credited. Pretty simple. Mr. Mehta invested 50,000 cash in the business. So what is happening here? Cash, which is an asset, is coming in and capital is increasing. Increase in capital is credited. So cash account debit to capital account. Simple. Increase in liability is credited. So Mehta Bookstore purchased stock from book dealer Hari worth rupees 10,000 in credit. So here purchases account being debit and Hari being our creditor, because we have purchased books in credit, we are creating a liability for ourselves in the form of creditor, which is Hari. So that account will be credited. Then we have decrease in expenses, which is credited. Decrease in expense. Mehta Bookstore paid staff salary of 6,000 in January 10. Staff left the job and returned half salary on 15th February. So on the day of January 10, when the payment was made, what happened? There was an expense, increase in expense. If we consider increase and decrease factor, so there was an increase in expense. On 10th January, increase in expense is debited. So what happened? On 10th January, salary account was debited, and cash being an asset which is decreasing, it's credited. So salary account debited, cash account credited. Then on 15th February, what happened? He returned half of the salary. Since he returned half of the salary, there was an decrease in expense which is credited. So here the salary account will be credited, and what is coming in? Cash is coming in the form of asset, increase in asset, that is debited. So cash account debit to salary account. Then we have decrease in loss which is credited. Stock worth rupees 5,000 was destroyed by fire on 10th January. Insurance company gave insurance cover of 1800 against the fire loss on 24th February. So what happened? On 10th January, there was a loss by fire of stock. Since the stock was destroyed by fire, there was a reduction of stock. In these cases, what happened is that we credit the purchases account and we debit the loss by fire account, because increase in loss is always debited. So on 10th January, since there was a loss which was created, there was an increase in the loss, and loss by fire account is debited. Purchases account, being the stock being reduced due to fire, is credited. On 24th February, the insurance company gave 1800. So what happened? There is a reduction of loss. Okay, on 24th February, because had the insurance company not given the money, our loss would have been 5,000, but insurance company gave the money 1800. So there is a decrease in the loss. Like earlier 5,000 was the loss, now 3,200 is our loss. Okay, so what is happening here? There is a reduction of loss. The reduction of loss or the decrease in the loss is credited. So, and we have received the money. So insurance claim debit to loss by fire, decrease in loss being credited. Insurance claim, or if it is in the form of cash or insurance claim account debited, loss by fire account is credited. Now next is increase in revenue is credited. Increase in revenue, simple. Mehta Bookstore sold books worth rupees 10,000. Sale happening, it means there is an increase in revenue. Increase in revenue is credited. Since Mehta Bookstore has sold the goods in the form of cash coming in, which is again an asset, and asset, increase in asset is debited. If we link all of this, we'll see that cash is debited and books being sold being credited, because increase in revenue is credited. Then we have increase in gain is credited. Increase in gain. Mehta Bookstore sold pen at 4,000 which was purchased for 2,000. So now there is a gain of 2,000. What will be the entry? Increase in gain is credited. So here cash account debit. We have received a cash of 4,000. The pen was of worth 2,000 which is credited, because asset is going reducing. Decrease in asset is credited. So fan being an asset going out of our hand is credited, and the profit increase in gain is credited, and hence the profit is credited with 2,000. So here we have covered the scenarios wherein the respective account will be debited or credited, and based on which we can pass the journal entries. In the next class, we will study about the next method, which is the golden rule or the traditional approach method of passing the journal entry. Thank you for watching.